Have you ever looked at a candlestick chart and felt completely lost? Those red and green bars flashing on your screen, moving up and down, seemingly at random. You wonder if there's a secret language that professional traders understand, but you don't. Well, here's the truth. Candlesticks aren't just random shapes on a chart. They're telling you a story. A story about fear, greed, control, and power in the market. And today I'm going to teach you how to read that story like a professional trader. By the end of this video, you'll understand the hidden language of candlesticks. You'll learn how to identify the 3 major types of candles that professionals watch every single day. You'll discover why context is more important than memorizing hundreds of patterns. And most importantly, you'll see candlesticks not as confusing graphics but as a narrative unfolding in real time. This isn't about becoming a fortune teller. It's about understanding market psychology. It's about reading the emotions of thousands of traders compressed into simple visual forms. And once you grasp this skill, you'll never look at charts the same way again. So let's dive deep into the world of candlestick analysis and transform you from a confused beginner into someone who reads markets like a professional. Before we decode any patterns or strategies, we need to understand what a candlestick actually is. Think of a candlestick as a snapshot of a battle between buyers and sellers during a specific time period. It could be 1 minute, 5 minutes, 1 hour, or even 1 day. Every candlestick has 4 critical pieces of information: the opening price, the closing price, the highest price reached, and the lowest price reached during that period. The rectangular part in the middle is called the body. This body shows you the distance between where the price opened and where it closed. If the price closed higher than it opened, the body is typically colored green or white. This tells you buyers were in control. Now, those thin lines sticking out above and below the body, those are called wicks or shadows. The upper wick shows you how high the price went before getting pushed back down. The lower wick shows you how low the price went before buyers stepped in and pushed it back up. Here's where it gets interesting. The size of the body tells you about momentum and conviction. A large body means there was strong, decisive movement in one direction. Traders had conviction. They were confident. Hey guys, real quick, I wanted to talk about building up your capital. Because without steady income, none of the things you're watching in this video is possible. The way I did it was by using this trading program. It shows you how to use multiple funding accounts along with their indicators to make big profits from small moves in the markets. The best part about it is, the program allows you to buy it now and pay for it later. They teamed up with a firm, Afterpay and Klarna, so you can essentially start making monthly income from trading without even paying for the course. Check the link to a short video that explains everything. Now back to the video. Now that you understand the anatomy, let's talk about the 3 types of candlesticks that professionals watch religiously. This framework will simplify everything and help you make sense of any chart you look at. The first type is strength candles. These are the candles that scream confidence and control. They have large bodies and relatively small wicks. When you see a green strength candle, it means buyers were in complete command. Strength candles are your momentum indicators. They show you which side is winning the war. Multiple strength candles in the same direction, that's a trend forming or continuing. The market has made its decision, and one side is clearly in control. The second type is control shift candles. These are the game changers. These candles have large wicks, especially in the direction opposite to the body. The classic example is a candle with a long upper wick and a small body near the bottom. Control shift candles appear at potential reversals. They signal that the balance of power might be changing. The previous trend might be losing steam. These are the candles that make professional traders sit up and pay attention because they suggest a story is about to change direction. The third type is indecision candles. These have very small bodies and can have wicks of various sizes. The most famous indecision candle is called a doji. A doji happens when the opening and closing prices are almost identical. Indecision candles reveal equilibrium. Neither buyers nor sellers have control. The market is thinking, hesitating, waiting for new information. In a strong trend, these candles suggest the trend might be exhausting. At key levels, they suggest a major decision is coming soon. Understanding these 3 types is your foundation. Every pattern you'll ever learn falls into one of these categories. And the professionals don't memorize hundreds of patterns. They understand these 3 types and read the context around them. Let's talk about some specific high-probability patterns that professionals use to make trading decisions. Remember, we're not just memorizing shapes, we're understanding the psychology behind each pattern. The first pattern is the bullish engulfing pattern. This happens when a small red candle is followed by a large green candle that completely engulfs or covers the previous red candle. The story here is powerful. Sellers were in control, but buyers came in with overwhelming force. The opposite is the bearish engulfing pattern. A small green candle followed by a large red candle that completely engulfs it. Buyers tried to push higher, but sellers overwhelmed them. When this appears at resistance, it's a major warning signal. Next, let's talk about the hammer and the shooting star. The hammer has a small body near the top and a long lower wick. This shows strong rejection of lower prices. The shooting star is the opposite, suggesting the upward move is running out of steam. Then we have the pin bar, which is similar to the hammer and shooting star. A pin bar has a very small body and one very long wick. Professional traders love pin bars at key levels because they show clear rejection of prices. Finally, let's discuss the doji. A dragonfly doji has a long lower wick, showing bullish rejection. The gravestone doji has a long upper wick, showing bearish rejection. These represent pure indecision or exhaustion in a trend. Now, here's what separates beginners from professionals. Beginners see a hammer and immediately think, buy signal. Professionals see a hammer and ask, where did this appear? What's the context? What's the volume? This brings us to the most important concept in candlestick analysis. Context is queen. I cannot stress this enough. A candlestick pattern without context is almost meaningless. The same pattern can be incredibly bullish in one situation and completely unreliable in another. This is what professionals understand. They look for confluence. Confluence means multiple factors coming together to support the same conclusion. The candlestick pattern is just one piece of evidence. You need more. Key support and resistance levels provide crucial context. A reversal pattern at these levels is far more reliable than one appearing randomly. Think about it logically. Support levels are where buyers have previously stepped in with force. Volume is another critical piece of context. A bullish engulfing with high volume tells you there was genuine conviction behind that buying pressure. Lots of traders participated. But the same pattern with low volume, it might just be noise. Time frame matters enormously. A candlestick pattern on a daily chart carries far more weight than the same pattern on a 1-minute chart. Higher time frames filter out noise and show genuine market sentiment. Professional traders often use multiple time frame analysis. They might spot a pattern on a 4-hour chart, then check the daily chart to see if it aligns with the bigger picture. If the daily chart shows a strong downtrend, they'll be cautious. Let's address some common mistakes that beginners make when reading candlesticks. These mistakes can cost you money, so pay close attention. Mistake number 1 is pattern hunting. This is when traders desperately search for patterns on every single chart, at every single moment. They see a hammer and immediately think it's a reversal, regardless of context. Quality over quantity. One great setup is better than 10 mediocre ones. Mistake number 2 is ignoring the story and focusing only on the shape. A candle isn't just a shape to memorize. It's a story about what happened during that time period. When you see a long lower wick, think about what actually happened. Sellers pushed hard but buyers rejected those prices with force. Mistake number 3 is trading based on a single candle in isolation. One candle rarely tells the complete story. Professionals look at candle sequences and combinations. A single indecision candle might mean nothing. But 3 in a row after a strong uptrend? Now you have a story. Mistake number 4 is using time frames that are too short. I see beginners analyzing 1-minute and 5-minute charts, trying to catch every small move. These time frames are incredibly noisy. Start with daily charts or at minimum 4-hour charts. Higher time frames set the direction. Mistake number 5 is forgetting about risk management. No candlestick pattern works 100% of the time. Professionals always have a stop loss. They always know their risk before entering a trade. The pattern might be perfect, but if it goes against you, you need protection. Mistake number 6 is not backtesting. Many traders learn about patterns and immediately start trading with real money. Professionals test their patterns. They go back through historical charts and see how often their patterns actually worked. They understand the success rates. Avoiding these mistakes is what will set you apart. Now that you know what not to do, now let's talk about some advanced concepts that will take your candlestick reading to the professional level. Markets don't move in straight lines. They move in waves of impulses and corrections. Understanding where a candle sits in these waves is the key. Strength candles usually appear during impulse moves when one side dominates. Indecision candles often appear during corrections when the market pauses. Professional traders identify these waves and anticipate where certain candles are likely to appear. Second, pay attention to candle positions. A doji at the top of a steep rally carries more significance than a doji in the middle of a range. Position matters. New highs with a shooting star? That's a potential reversal at a critical moment. Third, understand closing momentum, where a candle closes relative to its high matters. Fourth, recognize fakeouts. Markets create candles specifically designed to trap traders. A pin bar that looks perfect but immediately reverses is often smart money at work. Fifth, use candlestick clusters in zones. Sometimes you'll see an area with multiple hammers or shooting stars over several sessions. These zones become even more significant than individual candles. Combine this with broader price action principles like market structure and higher highs. When you combine candlesticks with price action, they become exponentially more powerful. You're no longer just looking at shapes, you're reading the footprint of institutions. Let me share a real-world example that brings everything together. Imagine you're watching a stock that's been in a strong uptrend for several weeks. You see consistent green strength candles with small wicks. The story is clear. Buyers are in complete control. Then the stock reaches a previous all-time high. This is a significant resistance level because many traders have memories of this price. Some might have bought at the top last time and are waiting to break even. Others see this as an expensive level. At this resistance you see 3 candles form. First, a green strength candle that pushes to a new high but starts to slow down. Second, a doji appears. Indecision. Third, a bearish engulfing candle forms. A large red candle covering the previous green. What's the story here? The uptrend reached resistance. Buyers tried to push through but momentum slowed. Then indecision appeared with the doji. Finally, sellers came in with force, creating that bearish engulfing. The balance has shifted. Now add context. Volume on that bearish engulfing was significantly higher than the average. This confirms many participants were involved. On the daily chart, this area aligns with a Fibonacci extension level. Multiple pieces of evidence suggest this resistance is strong. A professional trader seeing this would recognize a high probability short setup, or at minimum a warning to take profits on long positions. The candlesticks told a complete story when read in context with support, volume, and market structure. As we wrap up, I want to leave you with some final thoughts and action steps. Candlestick analysis is not about prediction, it's about reading probabilities. It's about understanding what the market is telling you right now, and making informed decisions. Start with the basics. Master the simple patterns like engulfing, hammer, shooting star, and doji. Learn to read them in context. Practice on historical charts and backtest your ability to build intuition and confidence. Combine candlesticks with other forms of analysis. Use support levels, trend lines, moving averages, and volume. The more confluence you have, the better your edge. Candlesticks work best as part of a complete trading system. Once you truly understand how to read candlesticks like a professional, you'll have a skill that works in any market, any time frame, and any asset class. Stocks, forex, crypto. The principles remain the same because human psychology remains the same. Candlesticks are telling you a story every single day. The question is, are you listening? Starting today, don't just see red and green bars. See the battles, the shifts in power, and the narratives unfolding. That's how you develop true market literacy. Thank you for investing this time to learn with me today. Now go out there and start reading the market story. Your trading will never be the same. I'm Bobby Yoshi, and this is Yoshi Trades. I'll see you in the next one.